Matt, I show a couple people logging in here, so we'll give them a couple more minutes here and
Great.
fill up the queue. Is it snowing there in Denver?
We're getting a little bit, nothing sticking right now. We had a couple inches. What was that? Sunday night, 4 or 5 more inches.
Okay. Got a few more people joining us. Looks like.
Great. How was you guys? Getting more snow?
Yeah, finally started snowing a little bit today, so we need.
How's your season? How's Wolf Creek?
It's good. We got a lot of snow early, but we need some more now. So after all the spring breakers have skeeted off. Well, let's get started here. It looks like maybe got a few latecomers. If somebody knows how to give me a thumbs up that you can hear Matt and I, that'd be great. This is, most of you know me. This is Bob Scott, president of Scott Strategic Investments. I've been here in Pagosa Springs working with investors since 1998. Prior to that, I was an analyst on Wall Street and spent some time in private equity. I'm a certified financial planner, and we are a comprehensive wealth management firm. I hope everybody is mending from the disruption of COVID, and our thoughts continue to be with you and your families during this period. So this is the third in a series of online webinars that we're having. Tonight, we're going to talk about ESG investing. ESG investing has been in the news very consistently, especially since the pandemic. Why are we interested in sharing information about ESG? 3 reasons. It's gaining huge acceptance globally as a meaningful tool to analyze investments, and it's here to stay. Number 2, COVID-19 accelerated the investment materiality of ESG factors. ESG funds saw over 135 billion in fund flows in 2020, and I expect that to continue. Finally, and probably most importantly, I believe ESG is very important for my clients, and I believe it can help all of us achieve our long-term financial objectives more effectively. Just a fun fact, companies with sustainability at their core outperformed their peers during the COVID crisis, drawdown and recovery. So to me, it's not just about doing good, but also what's an effective lens to evaluate investments for the long term. So tonight, we're joined by Matt Mackey from BlackRock. Matt's a director at BlackRock and earned his Bachelor of Arts in Economics and English from Loyola University in Chicago and holds the CIMA designation, Certified Investment Management Analyst designation from Wharton. For those of you who don't know who BlackRock is, and correct me if I'm wrong, Matt, but they are now the world's largest asset manager. In addition to that, their CEO, Larry Fink, has made sustainable investing a key element of their long-term strategy, and he has taken great lengths to encourage CEOs around the world to view their businesses with a view towards ESG. So tonight, let's learn about ESG and a little bit about BlackRock. Matt, take it away.
Awesome. Let me share my screen and we'll flash this first slide. I'm assuming you can see it. Let me know if you can't. But
yep.
Thanks for the intro, Bob. I think that's an awesome intro to sustainability and why from BlackRock. You know, you made the comment about Larry Fink. Larry Fink has been pretty adamant that as the world's largest asset manager, about $9 trillion in assets these days, sustainability is the new standard of how we're operating. Do you see the screen okay, Bob?
Oh, yeah.
Okay, good. So like when you throw a big word on the screen, sustainability. Like I think there's a lot of folks that grapple onto sustainability, and it probably aligns with values and sustainable targets long term. But there's also folks that maybe don't have this maybe, let's say, environmental connection to sustainability. Sometimes sustainability gets lumped in with some environmental issues. Now, I think bottom line, and Bob did a great job introing sustainability as a conversation this way, is this is a conversation not about your environmental views. This is about, does sustainability belong as a part of the investment conversation? And I think when we look at long-term investing, historically we were just kind of looking at the top of the iceberg here, the top of the glacier. There's ESG aspects that can open up a universe of conversations that can enhance the dialogue of, are there risks that we were otherwise unaware of? Are there opportunities that we should be aware of? You think about 5 or 6 years ago now at this point, was that Volkswagen emissions scandal, right? Like think back to how serious of a deal that was. They had violated the US Clean Air Act. The CEO resigned. The stock plummeted about a quarter in a single day. And so I think what's interesting about that Volkswagen conversation here is there's, in hindsight, and even all the media headlines was about the emissions scandal, right? I think it's really easy to think back on that Volkswagen scandal and think that was an environmental scandal, right? Well, the truth is they were falsifying the data. It wasn't as much of an environmental scandal as it was a governance scandal. They had a ton of former CEOs, highly invested folks on their advisory board. We would have never seen this coming by looking at it purely environmentally. It was really about the governance. They had aggressive sales targets from their sales folks. So this ESG conversation really isn't about the environment. It's adding clarity to some things that otherwise would have been opaque. Like, can we find some red flags in a company that we otherwise wouldn't see if we were looking at these traditional financial analysis? So in the Volkswagen, I mentioned that former executives dominated their board. They had a lot of significant shareholders on the board. And then the sales culture was really about pushing the envelope on not just selling cars, but on the emission scandal. It wasn't really an environmental issue. It was more of a governance issue. And so when we think about ESG, frequently those three letters get lumped in together. ESG. Those are three distinct ways of looking at investing: environmental, social, and governance. And we'll kind of unpack those three during the presentation today. So we're going to cover a couple things. We're going to go a little bit deeper on what is ESG, this term that gets thrown around everywhere. And we'll talk a little bit about how looking through the lens of ESG can identify some risks to sidestep. But it's not just about avoiding risk. There's some opportunities out there. Bob made the comment about the amount of money we're seeing flow into ESG and sustainable investing. There's definitely some opportunities. And then by the end, we can lay out a framework of why sustainable investing really belongs as a part of an investment policy statement and why it's really not going anywhere. So when you think about ESG, I said it's three distinct qualities of research. There's environmental, there's social, there's governance. Just to unpack each of these, you think about environmental, climate change, natural resource, pollution and waste. You think back again, bringing it back to the Volkswagen scandal, it wasn't just the climate change. It was really that third column, the governance, the accounting practices, the ethics, the ownerships, the board's independence. There was so much influence going on at Volkswagen. Environmentally was the headline noise, but from a governance standpoint, there were all sorts of red flags that we probably should have been more aware of. We'll unpack each of these columns, the environmental, the social, the governance. But you think about risks and you look down at the list on the left-hand side, what type of risks can ESG investing uncover? Think about extreme weather, that second one down. I'm a young guy, 38. We've got 2 young kids under 4. My wife and I just bought a home in Denver, a new home about a year and a half ago at this point. And we got, like a lot of folks, a 30-year mortgage. You think about who issued us that 30-year mortgage. And in Denver, it's maybe not as much of an issue, but think if I were that same bank issuing a 30-year mortgage to a home in coastal Florida. There's a lot of talk that some areas of coastal Florida will be underwater in 2050. How do I not do the due diligence on issuing a mortgage with potentially a home that could be underwater? It's got to be a part of the risk of investing in that type of mortgage. Or jump over to the other side, the opportunities. You think about clean tech or water efficiency. Yeah, sure. There's in my own household, my wife's from Boulder. There's a little bit of a flair of let's be energy efficient, water efficient. But what is the opportunity there, right? Like if a company is more efficient with the resources that they use, there's less friction to growth if that resource becomes more expensive going forward. If I operate my business more efficiently with resources and the cost of those resources go up, I'm less impacted. There's more opportunities for that company to grow. Or think about clean technology. I don't have to believe in clean technology. I might still like my F-250 out front, but there's an opportunity as policies are starting to support that clean technology and consumer demand. So it's not just about sidestepping the risks. It's about putting ourselves in a position where we can uncover those opportunities. And I think this slide is hopefully a good example of just basic terms. If I've got some money I'm thinking about investing and I'm looking at two companies, A and B, and on the left-hand side, both of these companies hit the traditional financial characteristics, right? Like the table stakes of me wanting to invest in a company. They're growing their profits, they're growing their dividends, they're leaders in their space with a high market share. Those are those traditional financial characteristics that the industry's been asking of companies for 30, 40 years, longer. What about the section on the right? Fair CEO pay, robust data security, employee satisfaction. I'm probably more likely to invest in company A if their employees are happy. They're probably going to be sticking around. They don't have to worry about onboarding new talent every couple of years. Data security, we'll walk through a scandal that happened a couple of years ago with Equifax. Not having proper data security can lead to problems of long-term sustainability. So as I look at company A and B, it's probably a coin toss if I look at the metrics on the left. If I look on the metrics on the right, well, I'd probably be a fool to not have a little bit of a preference for company A. If it's my money long-term, I'd want to invest in that type of company. And to Bob's point, investors have been rewarded for thinking this way. This is just looking at the performance of a couple different indexes, right? An index is just a compilation of stocks that make up the index. So a pretty familiar index to a lot of folks is the S&P 500 index. So when CNBC or Wall Street Journal frequently talks about how the market did that day, they're talking about the 500 stocks in the S&P 500 index. So that broad index for the last 5 years is up pretty good return, 16% there. You can see it in the bottom of the screen in the green. And if I look at also a broad index, the US index, but I add an ESG screen to it. I still look at the same companies, but maybe I avoid a couple that I don't like the risks there, or I invest a little bit more in the companies that I see as opportunities through this ESG lens. You end up getting about 1% of additional return annually for the last 5 years. And I think, even me sometimes I'll look at that and I'll say, well, that's just 1%. I mean, that's pretty close. You think about $1 million portfolio, two of them, one does 1% better for 10 years. At the end of 10 years, that's a $200,000 difference. So 1% annually can have a pretty big deal. We're talking about 5 years of annual difference. You go 10 years, $1 million portfolio, that's 200 grand of additional return. These are big numbers when you take a look at the differences and the compounding effects. So, let's take a look at a couple of the case studies for each of these things, for environmental, for social, and governance. There was a company a couple years ago. It's called Vale. It's spelled V-A-L-E, but it's pronounced Vale. It's the number one producer of nickel in the world. And they had a pretty tragic accident about 2 or 3 years ago. There was a dam that burst. There was a dam disaster, and it leaked about 3 billion gallons of mine waste, and it killed almost 300 people. It's a horrible situation. The crazy thing about it is that if you looked at financial analysts at the time, and again, this is just 2 or 3 years ago, the general consensus was they were pretty positive on Vale. The price targets on Vale were all broadly trending above what the stock price was currently at. But if you didn't look at the financial analysts and their view of Vale, if you looked at the ESG analysts and how this company scored from an ESG screen, it was one of the lowest scoring companies. They had horrible health and safety measures. They were having a terrible impact on local communities, biodiversity, land use. They were just not paying attention to any of that stuff. So if you had an ESG screen to something like Vale, there were all sorts of red flags. But if you just looked at it from the financial lens, and as most of the financial analysts did, they had a positive price target. When it came to this horrific event, Vale's stock fell 25% in a single day. They lost $19 billion of market cap value in a single day. And on the screen here, it says the direct cost to them from the accident, from that dam disaster, was $5 billion. So they lost close to 20 billion in market cap, and they lost 5 billion in expenses.
Matt,
that's a big cost. Go ahead, Bob.
Yeah, I just wanted to say that Vale, it was in so many mutual fund and index portfolios back then. I mean, I have a habit of looking at top 10 holdings in a lot of funds, and it was, ubiquitous all over the place. So, with a little bit of ESG filter, that could have gone a long way.
Yeah, it was not a small company. It's the world's largest miner of nickel. So a huge company. And they're not alone either. There's, on the red bars here, they're showing a couple different things. The farthest left red bar has that number 7 above it. So going back for 30 years, between 1980 and 2019, the average number of billion-dollar disasters we saw was about 7. You look in the last 4 years of 17, 18, 19, and 20, we've seen more than double that. So these aren't one-off things. They're happening quite a bit, and they're actually happening at a greater pace, unfortunately. So looking at these companies through an additional lens can help us avoid some of those risks out there that we otherwise wouldn't have seen if we're just looking at the financial metrics. I hinted at this one earlier with Equifax, the largest data breach in U.S. security or in U.S. history, as it says. You think about a year before the data breach, and it's almost very similar to Vale, right? At the top of the screen, you can see that green circle with the plus mark. Financial analysis was generally positive on Equifax stock. This is a year going up to before the data breach. Well, because of how Equifax was doing business, they were actually downgraded to a CCC rating according to ESG statistics. It's the lowest possible score you can get from an ESG lens because of how they were doing with data privacy, their loose companies' corporate strategies. They didn't have a very rigid policy around data security. Flash forward a year after that downgrade, and if I was looking at that company purely based on financial metrics, they suffered quite a bit. So that's one of those social aspects. How are they constructed? You think about, as employees out there, there's a lot of employees that look at their own companies from this social lens too, right? You think about the number of Americans who leave their jobs due to unfairness, discrimination. This is back to that broader sustainability. If I have the option of investing in a company that's going to keep its employees, I don't want a whole lot of turnover. I want predictability. I want a company that's doing well to grow, and they typically do that by keeping their best talent. 2 million folks leave annually due to unfair discrimination. And that has a huge impact on the company. It's not cheap to hire and replace some of this talent. So it costs collectively about $65 billion to replace this talent that's turning over. You could probably expect that a company that is a little bit more long-term oriented, a little bit more focused on sustainability, keeping their workers happy, keeping them employed with their company, they don't have that cost friction to long-term growth. And then moving along to the third example, we'll talk about in the governance side is a company called JBS. JBS is not a household name. It's not one most folks in the US would know, but think about it as like a Tyson Foods. In fact, it's like a Tyson Foods if you added about $20 billion more in sales than Tyson Foods. It's a huge company. So they got fined about $3 billion a few years ago. And it's like the same conversation we had on these other two companies. 60% of analysts had a positive buy rating on JBS, but if you looked at it from an environmental, social, and governance screening, they also had a terrible rating. It was a CCC rating. It was the lowest possible rating. Turns out JBS had done something like bribed 2,000 politicians. They bribed 2 former presidents. I think this is down in Brazil. They were lit up across the board for environmental, social, and governance violations. If I was looking at that company purely on financial numbers, the majority of financial analysts said that that company was a buy. You look at it through a couple ESG screens, and it would have said this company has got corruption everywhere. Their corporate governance has red flags everywhere. So you think about board structure, diversity, accounting practices. Board diversity is racial diversity. It's male and female diversity. In fact, there's a stat they put up on the slide here that companies in the top quartile for gender diversity are 25% more likely to have above average profitability. So there's some folks that will want board diversity because they believe in it. My wife believes in board diversity. She wants equal opportunity for our 4-year-old daughter. She wants to promote board diversity. As an investor, as I think about our long-term financial plans, I want to invest in the companies that have board diversity because they're more likely to have above average profitability. You can actually have it both ways. It's not just a belief system. It's also an opportunistic system, thinking about these companies through this ESG lens. So we'll shift a little bit here toward the opportunity. Consumption habits are changing. Consumers are changing the way that they buy things. Close to 90% of shoppers begin product searching online. And when was the last time any of us bought something without looking at it online, right? My ski jacket zipper just broke. I mean, I probably spent 2 hours looking at ski jackets and like the sustainability of jackets and companies. My last jacket I bought from a company that's no longer around. They don't honor the zipper warranty anymore. Like there is something there. I want to buy a company that's sustainable, that's going to be around. I want to work with those companies. The stat on the right, I'd never seen that. 51% of smartphone users changed carriers because of what they saw about a carrier online. So people are not only buying things based on what they find online, they're changing who they partner with based on what they see online. Impact on business: 73% of consumers would change their consumption habits to have an impact on the positive impact on the environment. 88%, as you can see, of consumers want brands to help them live sustainably. Consumers are changing their behavior and they're demanding change from these companies. There's a huge opportunity to invest in these companies that are capturing that. You think about clean energy. This is one of those more thematic things. If you believe in the clean energy revolution that a lot of politicians are talking about, it's not going to come for free, right? We're gonna have to make a sizable investment to position ourselves for clean energy. So what a lot of institutions are talking about that have done the research are saying it's going to take about $2 trillion of investment to put us in a position where we're implementing clean technology, clean energy. That is an opportunity. There's an opportunity to position our investments not just for broad ESG investing, broad screens, but this is more of a thematic, sustainable theme of clean energy. And you can think about investing in ESG as broad or thematic. And I've got one slide at the end of the presentation I want to show you that kind of, for me, helps me conceptualize this broad opportunity of sustainable and ESG investing. So why does BlackRock think that sustainability is a standard? Why have we committed to that? Companies are getting on board. You think about 10 years ago, only 20% of companies on the far left-hand side disclosed ESG information. Just a couple of years ago, it was all the way up to 86%. Now it's over 90% of companies are disclosing ESG information because investors need the data, are asking for the data. And so if I'm a company and I want investors to invest in my company, I got to be transparent. I got to show the data. And this isn't just a grassroots movement. This is big money looking at environmental, social, governance screens. 70% of institutional investors have already implemented these ideas. More than 70% of retail folks. I'm a retail investor. My wife's a retail investor. Her family's, the people off the street are retail investors. 70% of folks have expressed interest in sustainable investing. So this isn't just a concept. It's something that people are taking action on, and the dollars support it. So this is an asset growth chart. These are not performance charts. It's just looking at the billions of dollars that are in and growing in ETFs on the left or mutual funds on the right. And I would think about ETFs or mutual funds as just packaged vehicles, right? This is saying, I want a reputable company to pick investments on my behalf. So as we invest in ETFs or mutual funds, you see the amount of growth in these vehicles of mutual funds or ETFs. Call it $220, $230 billion. BlackRock sees that that's going to be $1 trillion in the next decade. So we think there's going to be a 4x increase in the amount of dollars going into sustainable vehicles, sustainable investments. So the vision for the future on sustainability, it's not just an environmental issue. It's not just a social belief issue. I hope the presentation has separated that from it's not that I have to agree or disagree with climate change. Let's leave that at the door. This is an investment opportunity. It's let's put the risks in the right categories. Let's put the opportunities in the right categories. And I think we finish here with a quote from our CEO. Bob did a great job teeing up Larry Fink. He's our CEO and founder. He founded BlackRock about 30 years ago. He writes an annual letter to the CEOs of the Fortune 500 companies, and he also provides a letter to all our shareholders. And in the summary is, we have to offer clients better outcomes. We're making sustainability an integral part of how BlackRock manages risks, builds portfolio, designs products, engages with companies. Sustainability at BlackRock is key to how we do things. We are looking at sustainability metrics the same way that we would look at credit risk for a company or interest rate risk for a company. And the last thing that I would say, because this helps me think about the choice that everyone here has about how to think about ESG investing. There's some screens out there that are avoid screens. They're negative screens. And that's okay. That's a part of sustainable investing. That part of ESG investing started 50, 60 years ago with actually a little bit of a religious tint, saying we're not going to invest in companies that operate in these types of businesses. So that's a type of ESG investing. So you can screen out things that we don't necessarily believe in. What we're seeing more widely adopt going forward are these ESG strategies that can advance and look forward to, how do I want to invest broadly or even thematically? So when you think about broad ESG investing, I made that comment about the S&P 500. Well, maybe I want the broad US market, but I don't want to own every company just based on how big they are. I want to own the companies based on how they score on sustainability metrics. Well, broad ESG investing can still give you a broad exposure, but with tilts toward the opportunities and tilts away from the risks. Or the third category here in pink is the thematic investing. It's that example of the clean technology, clean energy. That would be more thematic. Or the last type of ESG investing would be impact. What are these companies that their whole mandate, their whole intention is to make a measurable impact on the world? So when you think about ESG and sustainable investing, I like to think about it as 4 categories of investing. There's the negative screens, and not to put them in a negative box, but they say what we're looking to avoid. There's the broad, there's the thematic, and then there's the impact investing. And all of that is part of sustainable investing. So, Bob, I appreciate you having me. Happy to take any questions or have any conversations you'd like to have.
Yeah.
That is our presentation.
Yeah, let's see if there's any questions. And I'll tee it up with a question, and I hope I'm not blindsiding you, Matt, but it's always been, I've been doing this for a while now. And I have always appreciated large investors that exert their influence in a positive way to the benefit of shareholders. And, in the old days, that would be more along the lines of, financial performance, et cetera. But now I think Larry Fink is probably, the 800-pound gorilla. Can you talk about any ways that you've seen him have, kind of tough impact for positive ESG developments?
Yeah, so it's a really good question. So, like, if you look up almost any company around the world on Yahoo Finance, it'll tell you who are the top 5 or top 10 shareholders of that company. And I'd almost challenge you to find one that BlackRock is not a top 5 shareholder of. So when it comes to the proxy voting and the voting, BlackRock is committed to being more engaged. And so, whether it's I would think the auto industry is one for sure. Like, Volvo coming up and saying that they're not going to have a car on the road by, I think it's like 2025, that doesn't have an electrical component to it, like either some form of a hybrid or purely electric. What you're seeing Larry Fink say is we need the incumbents in the auto industry to take that step forward to make clean energy adoption. So I've seen it there. But the biggest thing he said is these companies are no longer going to just be able to write their own ticket. We're going to have an impact. We're going to be more vocal. And his big thing is the companies don't have this. They don't have this obligation just to their shareholders to make the profits. Larry Fink has said that these companies have an obligation to the communities that they operate in, to make the communities better. And there is some part of Larry Fink's comment that is opportunistic, because what he does to reinforce that is he'll even say companies that reinvest in their communities, that are part of the community, are companies that the community then wants to do business with. So companies that position themselves to support the communities are companies that will be rewarded with long-term growth.
Great. And when Larry Fink calls you, I'm sure and you're a CEO of a Fortune 500 company, and he's one of your largest shareholders, you take the call, right? I mean,
you got to take the call.
Yeah.
So part of this too is, BlackRock has a big index business. BlackRock doesn't create the index. If someone says, I want to invest in the S&P 500, it's not BlackRock's job to say, well, there's 500 stocks in the S&P. We don't like this one because of what they do to the environment. We can't eliminate that. All we can do is give investors choice and educate the investors on the choice of, hey, you can still get that broad exposure without rewarding that company with investment with your dollars. We can give you an alternative that screens them out.
Okay. No, that's great. Well, as you know, I like talking shop, so I could ask you questions for 3 hours here, Matt, but
Yeah.
I'm not going to do that to you, but I don't see any other questions. So I guess I would close by saying, hey, I really appreciate the presentation and your time tonight, and really appreciate BlackRock's efforts to, make money for clients and do the right thing at the same time. I think that's a great way to invest. And for any of you that are out there watching the webinar that are not clients of Scott Strategic Investments, we always offer a free, no obligation meeting or consultation if that's of interest to you. With that, Matt, you have a great evening, and everybody, thanks for joining us, and stay safe. Take care.
Thanks, Bob. Thanks, everyone. Have a great night.
Bye-bye.